What's up, Banter fam? Welcome back to the show. Today, I want to talk about an alarming altcoin trend which has been triggered by this meme coin run. It's been meme coin mania over the last few days. People seem to have completely forgotten about the rest of the altcoin market and has been pouring all their liquidity into coins like PEPE. So I want to talk about my theory here in terms of net inflows into the market and expand on why this actually may not be a great thing that we're getting this big meme coin season and how it's kind of lining up with some of the charts to signal some bearish signs ahead of FOMC. So I want to talk through that theory, then of course do some charting and talk about FOMC and the potential impact. We know that's a big announcement coming later today or tomorrow if you're in the US. And then at the end, we'll do a Q&A. It's going to be a shorter show today because I usually ramble on for way too long. So I'll try and keep it concise and deliver you guys the alpha/opinions in a more concise manner. So essentially, this big run over the last few weeks hasn't really been it's kind of been isolated to the meme coin market. It hasn't really affected the rest of the altcoin market. As we can see here on the crypto bubbles, if you go into the weekly and then you sort by top 100, PEPE obviously now being a top 100 coin in the market, we can see that PEPE is really the thing that's sucking all of the life out of the other alts. Like most other altcoins in the market right now are actually down, and then you have all of these meme coins, and if you go into the top 200, this is even clearer. You can see that all the meme coins are like pumping, and a lot of the other altcoins are essentially dumping. And the reason this is because what we're seeing is essentially not really much of a significant move from the total 3, which is basically the indicator of the altcoin market minus Bitcoin and Ethereum. So it is a bit frothy in terms of the current meme coin season. If we line this up with the ERC20 tokens being created, we can see that over the last 2 weeks, we've seen all-time highs in tokens being created, because what a lot of people are doing is they are essentially creating new tokens, new meme coins, launching them onto the market. A lot of them are rugs, and a lot of them are just opportunistic cash grabs. But we're seeing this meme coin mania, right? Because people are just creating tokens left, right, and center, launching them. Some are rugging, some are doing 100x's, 1000x's, 10,000x's in the case of PEPE, and we're seeing this increased activity on the ETH chain. Funnily enough, and Rand said this in the show yesterday, Ethereum has basically become like the biggest casino in the world. Now, it was already a casino because you could pretty much think about any crypto as being, speculation, as being a bit of a gamble, as being like essentially, a bet on other people speculating on whatever you're investing in. But the Ethereum network has basically turned into one big casino. And funnily enough, when you have all of this tokens being minted, and when you have all of these meme coins exploding, a lot of which are primarily based on the Ethereum network, you are going to see activity in the Ethereum network increase. And as a result, you're going to see a significant burn. And that's actually what we've seen on the ETH network. The amount of ETH being burnt is monumental. So meme coin mania, if it keeps going, it's actually quite bullish for the Ethereum network activity. And that's what we've seen since the merge. Ethereum has reduced 22,000. This is just over the last 7 days. But over the last 7 days, the Ethereum supply chain has been drastic. And if we go to the date of the merge, we can see that the supply chain has been even greater compared to proof of work, which would have pumped another couple $1 billion worth of Ethereum into the market. So I think the impact of the merge has been massive on Ethereum's monetary policy. One of the reasons why the network is in good stead. But the reason why there's been so much Ethereum burnt over the last couple of weeks, and the reason why we're starting to see this supply really tick downwards into the negatives in terms of yearly growth, so Ethereum becoming a deflationary asset, is because you're getting a lot of meme coins getting created, you're getting a lot of meme coins pumping, you're getting a lot of meme coins being launched and traded and speculated on chain. And it's interesting because actual total DEX volume on chain has been decreasing, so there's less trading happening on bona fide DEXs, but more speculation happening on non-bona fide meme coins. So just an interesting trend there. But needless to say, it's been quite a hyped couple weeks in the market, especially this last week. And we can see this on the DEX tools screener here, that the top 5 are basically all meme coins. So usually in a normal market, what you'll see is the daily gainers on the DEX tools board be a couple of DeFi protocols. Then you might have a couple, I don't know, layer ones, and then maybe a meme coin or two. But right now it's all meme coins, so there's no real other coins being traded nearly as heavily as 𝗏𝗏𝗏𝗏, PEPE, 𝗏𝗏𝗏𝗏𝗏, WSB. Like, these are the hot pairs right now that are gaining extreme traction in trading volume, and also as a result trading amount, so the actual market cap of these tokens. Someone just said they're excited to hear my bearish thesis. By the way, I'm not a perma bear. I'm just outlining why this could signal a local market top. That's basically what I'm going to get to, and I'll line that up with the charts as well. That's not saying that, I'm not forecasting some doomsday. I'm just kind of lining a few things up, and Memecoin Mania being a historical indicator of when alt seasons both start and end. It's really one or the other right now. I think if you actually go and back onto your charts and look at the Doge run of 2021, and then also recent Doge pumps, oftentimes that has resulted in kind of like the end of a cycle run. And Doge is also something that kicked off the bull run initially. So, there's people on the flip side arguing that it's the start of the run. Difference is we've been preceded by a huge Bitcoin move already, a huge move in altcoins already, a huge move in Ethereum already. Whereas when Doge kicked off the run, although Bitcoin had moved significantly, and we're at a different stage in the cycle now, you didn't see... you kind of saw that resulting in new liquidity coming into the market due to a lot of retail participants entering crypto due to Doge. That's why that started the cycle. Whereas now we're not seeing new inflows. We're basically seeing this kind of rotation of liquidity inside the market, which kind of leads me to think that it's the latter, which is a market kind of top signal, or potentially something that indicates we're getting frothy and toppy. But I'll get into that thesis in a second. I'm just trying to flesh it out here a little bit. So PEPE, in terms of PEPE's price itself, one of the indicators that I told you guys yesterday to look out for was when volume flipped market cap. Because typically when volume flips market cap, that is an indicator that a token is getting frothy and is about to set a local top. So Runner did a tweet a few hours after my show and actually saw that the fully diluted market cap had in fact flipped the market cap of PEPE. So we actually did see the volume, not the fully diluted market cap, the volume flipped the market cap and the fully diluted market cap of PEPE. And usually when that happens, now not always, and it typically needs to happen for a sustained period of time, but typically when that happens, that is a sign of general frothiness. Now, what actually happened after that was trading volume came right back down, halved, to 270 mil, and the market cap also came down to 500. So if we look at when volume actually did flip FDV, it was at 13.15. Now it's sitting at 1.9. So PEPE has reduced in price since we saw that, and GCR's thesis outlines the reason why this is sometimes the case, because this often leads to parabolas in final stages. Now, if we actually go and look at the PEPE chart, it's very hard to work out how high this can go, because on a relative basis compared to SHIB and Doge, it still is a 14x away or a 30x away. So there's really no limit for PEPE. And the thing with meme coins is there's really no limit for meme coins, but there were indicators yesterday that maybe we did see a slight local top. However, we did get the breakout, by the way, of the bullish flag. Then we pushed up, but you guys know how bullish flags work. If you don't, what you want to clear is the top level of the flag. So typically when we want confirmation on a bullish flag breakout, what you want is, from a TA perspective, a breakout of this top line, which we rejected off. So looks like PEPE might come down a little bit further today, but it's very hard to do TA on a meme coin because meme coins are so explosive and they kind of, run any which way, right? So if you are trading PEPE and meme coins, I have a full kind of guide on yesterday's show. We won't repeat that show, but basically the TLDR is treat it like the casino it is. The Ethereum casino is the biggest casino in the world at the moment. And for that reason, treat position sizes in a meme coin the exact same as you would on a roulette table. So if you weren't willing to bet $100 on a spin of roulette, then you wouldn't want to put more than $100 into PEPE. And that same logic applies if you were betting $1,000, $10,000, etc. Don't convince yourself that meme coin investing is investing. It's trading, and on that note, it's actually a gamble trade. So it's not really a proper trade. It's more just for fun. Now, I got into PEPE. I've made a 5x on PEPE. I only took out my initial, so I'm breaking even. I'm riding the rest of the profits. Why? Because if it goes higher, I might have some fun. I might make some money. And if it goes to zero, I don't really care because I'm treating it like a gamble. I'm treating it like roulette money. And I'm happy to keep it in. The second the amount I've got in PEPE exceeds the amount I'd be willing to bet at a casino, then I might take money out. But I'm not going to treat it like one of my other investments. Certainly not like a super long-term hold yet. We don't really know much about the team. We don't really know much about whether the community cohesion / hype is sustainable. We've kind of had that social proof from things like SHIB and Doge. So proof is still in the pudding for PEPE, but it has been an amazing run, and you just have to be careful. Now, meme coins have, opportunities for you to make 100x's, 1000x's, life-changing money. So I'm not saying don't play the game. It's just, when you play the game, you have to treat it like the game that it is, and don't let meme coin trading get in the way of your long-term investing, because we know that long-term, the biggest gains in this market are going to come primarily from buying amazing undervalued protocols that can change the world at low prices and accumulating over time. That strategy is like a bona fide way to, obviously, if you're accumulating at good levels, a bona fide way to get outsized returns on a longer time horizon. The problem is, I just see a lot of people now probably going to wreck themselves meme coin trading and halve their portfolios, or maybe they'll make some money, but then they'll get this gambler's mindset that they apply to the rest of their portfolio. No, treat it separately. Make a new, if you're going to invest in meme coins, what I would actually do is make a new wallet, transfer whatever money from your exchange or your other wallet into that wallet, and then just trade with that as a gamble. And literally call it gambling wallet. So you always remember that it's a gamble, and you don't start treating it like an investment, because that's when the danger really starts to kick in. So look, if you do want to trade PEPE, and it's risky, but look, this isn't on leverage, this is just spot. You can actually trade it on OKX now, which is cool. Because if you trade it on OKX subsequently, you will also qualify for the Tesla giveaway, which is now live. So this is huge. The Maldives giveaway ended yesterday. When OKX sends me the UIDs, I'll be giving that away on my show either tomorrow or the day after. So if you have been trading on OKX over the last month, make sure you watch my next 2 shows, because I could potentially be giving out the Maldives prize to you. Someone's going to win it, and it is kind of first come, first serve based on the trading volume that you've built up. So if you're in the final giveaway selection, then you want to be watching the show so you can claim your giveaway as soon as possible. And then we also have the Tesla, which is now live. So now that it's May 2nd, for the next 3 weeks, you can win a freaking Tesla, $50,000, or a Tesla. Choose whichever one you want. You could even redeem the 50,000 and then buy a Tesla. Someone said gas is crazy on roll-ups. Yeah, it is. It's absolutely nuts. What we've actually seen is zkSync, which is a layer 2 that's supposed to scale the layer 1, that's Ethereum, charge $40 for staking and $30 for withdrawals, which is crazy. I think, guys, we need layer 3s to scale the L2s that are supposed to scale the L1s. We actually need L3s, and what's next? L4s, L5s. I'm making a joke because ZK is a new product. It's the network obviously still has a lot of building to do, and the way the fees actually work on zkSync actually benefits off more users, because it essentially breaks up the gas fee amongst its user base that are demanding for transactions at any given time, which means technically if it had more users, the fees would come down. So the thing with zkSync is the reason gas is so expensive actually might be because there's not enough users. It's actually the opposite to Ethereum. So interesting, because it becomes scalable when you get more people in. But right now, since there's not that many people in crypto relative to other periods in the market, you're actually seeing extremely high gas prices. So Addy, if you are in the running for a Tesla, good luck. That's in 3 weeks. And the reason I'm mentioning OKX now is because they just listed PEPE, and you only really need to trade $1 to get 1 raffle ticket. So that's spot or derivative. So you could buy $1 of spot PEPE, technically qualify for a Tesla. Now, of course, the ones that do more trading and get their trading volume up are going to win more raffle tickets. So that's going to give you a higher chance of winning a Tesla. But if you just wanted to do $1, theoretically, you could do $1. So link in the description to that. Click on the OKX link, then click join now to enter the comp, trade $1, get a raffle ticket, trade more money, get more raffle tickets, and the Tesla giveaway is in 3 weeks. Maldives will be on the next couple days on my show. So basically what I was framing in the first 10 minutes of the show, just to summarize, was things are getting very frothy. You're seeing meme coins starting to pump. You're seeing speculation hit all-time highs. All my feed is interested about right now is meme coins. The market doesn't seem interested in other alts. It's just interested in memes. The ERC new tokens being launched is like skyrocketing and reaching like basically all-time highs over the last few days, which is crazy because there's more tokens being created now than back in the bull run. So things are just going absolutely insane. This is really meme coin mania. And okay, meme coin mania, right? In and of itself, you might think is a good thing. So why is it a good thing? Because it shows risk appetite's back in the market. Now, if risk appetite is back in the market, isn't that good for risk on assets like altcoins, like crypto? Well, the answer is yes, if you're getting net inflows. So when Doge led the 2021 rally, it had Coinbase listings, it had Robinhood listings, it had Binance, ByBit listings, and it was getting pumped because retail started to catch hold of this narrative. And, you know, your average mom and dad investor was buying Doge. Like your average person on the street knew Doge and they were buying Doge, right? So there were new inflows coming into the market. And that resulted in total 3 and total 2 and all these indicators that we use to track market, total market cap value, excluding Bitcoin and ETH, were pumping. So it was net inflows. It was really good. And that's when meme coin mania can be good, because what happens is it brings new money into Doge, new money into SHIB, new money into Flocky, and then that money then rotates into Bitcoin because people take profits into Bitcoin, people buy ETH, you know, maybe Doge is like a gateway drug, right? I think memes are a great gateway drug because people find out about memes, maybe they get on a DEX because of it, they realize how cool crypto is, and then they get into other stuff, or they're interested in, maybe they lose money and then they realize, oh shit, like I want to learn actually how to invest, how to trade. That's when it's good. When it's bad and when it can signal a market local top is when you're not getting new inflows. So when the money is circle jerking around crypto and it's just rotating around and around and around, that is when it's not good for the market. And unfortunately, that's what we're seeing right now. Now, this isn't like a guaranteed bearish signal or anything. Like it's not 100%. It's just a gut feel. And it's mostly my opinion and, you know, also the opinion of some of my peers that because we're not seeing new inflows, but because we're also seeing an extreme risk appetite, this is actually not great for other altcoins. Because of this liquidity sucking effect we're seeing. Liquidity sucks out of alts into PEPE. And a lot of that money won't go from PEPE back into alts. A lot of that money will go from PEPE back into stables. Maybe PEPE back into Bitcoin, but there's no wealth effect here because PEPE's market cap's only 500 mil. So people aren't making crazy enough money to like pump the Bitcoin price. Bitcoin volume's 30 bill a day, right? So that is why it becomes not a great thing for the market. Because you literally, since PEPE was launched 2 weeks ago, we've seen total 3 go down 10%. I mean, if we actually take, this is the weekly chart, if we actually take exactly 14 days ago, it's like 8% or 6%. So the market's actually down, right? 6% since PEPE launched. How does that happen? It's because no new retail's coming in. It's just liquidity rotating around. And that's not a great sign. So when I look at total 3 and I chart it, I start to realize we're actually in a downtrend. And I can just draw in the trend line here. We're actually in a downtrend. Now we have this local support of 353. If we don't make a higher high here, so if we come here and then get rejected again, then likelihood is we come back down and then, you know, you're starting to target 270. Now I'm not saying that will happen, but we have to be very wary now that if we don't actually see inflows from these new PEPE listings, this is not good for the market, in my opinion. So that's my thesis there. All right. So that's the first thesis. Secondly, Mars is now bearish. It's hard because I just go off charts and I go off sentiment, right? That's all I go off. I'm of the belief that crypto influencers or creators have no more merit than anyone else to call the market. Like, just because I say it's going up doesn't mean it's going up. Just because I say it's going down doesn't mean it's going down. I actually get quite repulsed when I see traders on Twitter and YouTube act like they know everything that's happening in the market. Like, they'll say, oh, it's going down now, it has to because of my indicator. Bullshit. Your indicator doesn't give a shit about the market. Your indicator doesn't give a shit about the FOMC data. Your indicator doesn't give a shit about the macro environment. But all I can do as a trader and an investor myself, and a content creator, is make the best decisions at any given moment based on the information in front of me. And based on the information in front of me, I see a huge run up in the Bitcoin price from 15K all the way into resistance at 30. Then I see a rejection, and now I'm seeing lower highs. So bias aside, bullshit aside, crap aside, opinions aside, that is just what I'm seeing on the charts. I'm seeing a lower high on Bitcoin, and that's not even the most important part. The most important part is that I'm seeing Memecoin Mania, but I'm not seeing alts go up. And when you see that, combined with a lack of total 3 movement, it's very hard to be bullish, all right? I am 100% happy to be very, very bullish if we start flipping on total 3 and if ETH BTC reverses above this orange line. Very happy to start flipping bullish. That means money's coming back into alts. Right now, though, that's not what I'm seeing. I'm seeing dominance on the verge of breaking out. I'm seeing ETH BTC in a downtrend. Rejection, 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 targeting this zone here later in the year. That's what I'm seeing. And if that's what I'm seeing, why would I long alts in the face of what could be a continued Bitcoin dominance run? Now, yes, if we reverse, I flip bias quick. The best traders, I'm not saying I'm the best trader, but in general, something that you can take from the best traders is that they always flip their bias super quick. If something happens, they'll flip. Like if ETH BTC starts to break up, I'll flip. Yeah, sure, I might miss a little bit of a run, but it's better than trying to catch a falling knife. So when people say, yeah, I'm bearish, that's kind of what I'm saying is, okay, I might be, but that's just because the data is telling me to be a little bit wary. But we also got FOMC tomorrow, and we'll get into that in a minute, and that's going to be a big driver behind the market at the moment. And that's going to be a huge driver of the macroeconomic outlook for the next few months. Now, Rand said something on his show yesterday that, this is probably the least important FOMC in the last few months, and I would tend to agree. But right now, the market's very confused. Why is the market confused? Because it's had unprecedented, well, not unprecedented because it happened before in the 70s, but it hasn't seen rate hikes like this in a long time. 25 basis points was the interest rate last year. It's now 475 basis points, heading towards 500 tomorrow. That's almost a 5% increase in the interest rates. The market's confused because now we're going to get a pivot. The likelihood is we get 2 rate cuts this year. So this will be the last hike, and then we'll get rate cuts. So the market is expecting a pivot. Now, a pivot should be a good thing, right? Yes, but also no, because the effect of the interest rate rises on the market haven't fully been priced in because we haven't hit a recession yet. And that's kind of what some investors are anticipating, that since there's a lagging effect between raising interest rates and the actual impact on the market, that maybe you get a stock market recession, right? And if a stock market recession hits, then crypto gets smacked because it's still relatively correlated. Then you also have the other school of thought that, okay, banks are collapsing. We've had the 4 biggest banking collapses of the year so far. First Republic, Silicon Valley, Signature Bank, Credit Suisse, 2 of which, or 3 of which are actually 3 of the biggest 4 banking collapses of all time. And that means the Fed needs to inject liquidity. And we saw the Fed's balance sheet actually increase. Look at the Fed's balance sheet. We can see that they actually injected liquidity into the market in the short term. So this is a QT environment, right? Just to contextualize where we are, the Fed took money out of the market for a little period in 2019. Then when the pandemic hit, they pumped money to the moon. Biggest money printing in history, doubled the money supply in a year. We all know that caused crazy inflation. They realized, shit, we printed too much money. We have to start tapering. So they started tapering. So that means, taking money out of the economy, albeit at a much slower pace than what they raised. So you're never going to get that money out, but maybe you can get 10 to 20% out, then maybe 30% out. But then the banks started collapsing. They're like, shit, if we don't protect the banks, consumer sentiment gets smacked, trust in banks decreases, people are going to get hurt. We have to inject liquidity. So then they injected liquidity into a bank term funding program. Liquidity, it basically wiped out half of their QT, and then they realized, crap, we have to continue with QT. We've just injected more money. So now they're reducing again. So it's a shit show. And the reason why it's a very difficult market to work out exactly where we sit from a macro perspective is because you have what is a very bearish outlook, I think, with the potential of a recession and a QT environment for risk assets. It's a very hard outlook for risk assets, but you also have this bank collapse, which is forcing the Fed's hand. So half of the market actually thinks, because of all these banking concerns, because of recessionary risk, they're going to have to cut. They're going to have to start printing money again. And when the money printer goes back on, risk assets will boom. So the Fed's response to a potential looming recession is really going to be the driver of the market. And I think, it's not just me, but macroeconomic experts are very confused. Everyone's very confused. And multiple big investors have said this is the hardest environment that they've ever had to deal with in their 50, 60 year careers. Like, this is the hardest environment. And the reason is because there's been unprecedented monetary policy from the Fed. Now, if you watch Harry Dent on Banter last Friday, he thinks that the Fed is eventually going to have to let the market go back to normality, which is basically let the market correct course, go through the boom cycle, and then go through the bust cycle and take money out of the economy so we can reset. And if he's right, stocks get smacked. And although Bitcoin could be a flight to safety, it's hard to make the same argument about a lot of altcoins. So it's a difficult environment. And kind of the weird thing is, here's the really weird. Now, this could just be confirmation bias, but if we line up the recession, okay, if you really want to stretch this theory, if you line up a looming recession in a couple months, with when we typically get market cycle bottoms, pre-halving, because we are in a pre-halving year, the halving is in a year. Typically, the best time to buy pre-halving is like Q3, Q4. Usually, you see a pump at the start of the year. Then price goes down, and then you start to see a recovery towards the end of the year. If we line that up with ETH BTC, which is our altcoin chart, you're reaching major support around September, October. You can see on the bottom, mid-September to late October is my target, roughly, for like where like a logical time frame in which this moves. Now, you can't just go sideways and chop, but I think we make a decision by then. That would probably line up with your recession. That would probably line up with maybe a Fed pivot, and that would probably line up with a stock market decline, which results in alts going down. And then that also lines up with what we typically see from reversals in Bitcoin halving years. So it could mean something like this. Now, that's just a complete thought experiment. It's a bit of rubbish speculation. I say rubbish because there's so many variables between now and then which can affect this thesis. But if we just like talk about fluky timeframes, it's kind of interesting that we're getting all of these events seemingly lining up in terms of time frame, pointing towards strong buying opportunities in Q3, Q4. That was my thesis actually at the start of the year. If you watch my 23 predictions for 2023 video, I think I said in that Q3 was when I was expecting like the best buying opportunities to be. And I mean, nothing is suggesting that won't be the case so far. And that's why I'm still pretty heavy cash. I'm not all in the market. If this is a new cycle, cool. I've got enough exposure to be happy, and we'll look to trade breakouts. And if ETH BTC starts breaking out here, we'll start longing, much heavier. Maybe even buy some spot. But until then, I'm still pretty happy being pretty heavy cash. And maybe that's different for some of the other hosts, but that's okay. We all have a different trading style. So that's what I'm seeing from the market. I kind of went off on a tangent there. Let's talk about BTC dominance real quick. So the best thing about BTC dominance is you don't need to, and I said this in yesterday's show as well, you don't need to predict a breakout or a breakdown. Traders often have this mindset, especially newer traders, that you have to like predict the market all the time. And like, I just made a few predictions, but like, I have to even acknowledge myself that those predictions are rubbish, because price action at the end of the day is going to give us the story of the market. The story of the market right now is Bitcoin is going up and altcoins are going down versus Bitcoin. That's the story of the market. Now, are we getting signs that is changing? No, we're not getting signs that's changing. Why? ETH BTC is still in a downtrend and Bitcoin dominance is still in an uptrend, right? You want a reversal to actually signal that there has been a shift from Bitcoin into alts, and then you want to get into alts. You can try and time a reversal, but I would much rather just wait for the market to react and give me that indication that alts are back in risk on mode. And maybe that is tomorrow after a bullish FOMC meeting, but that's not what we've got so far. So what I would like to see from Bitcoin dominance, if I was bullish on alts, is a reversal, rejection, bearish rejection, so no reclamation of the high at 48.66, and then a break below this bottom level, which is like your horizontal support on your lower time frames, and then obviously a continuation to the downside, that's a very good environment for alts to perform well. Unfortunately, right now it looks like dominance wants to go even higher because you had this flag, you had a breakout. Now you're having a retest of the neckline or the top line of the flag. If this is a retest, that could be a bullish retest to signal even higher for BTC dominance, which, by the way, has a 54% upwards target. So I'm just watching this. I want alts to pump as much as you, but at the end of the day, what I'm waiting to see is a breakdown below this neckline and then a bearish reversal for dominance. That would be good for alts, right? If we do get that bullish retest, then dominance probably goes higher. And if that's the case, well, I'm better off in Bitcoin than a lot of alts. Now, yes, there's select narratives which are performing, right? Like injectives, renders. There's coins like that which are showing relative strength. That's why it's so important to trade on the BTC pairs. And there are a few coins which, I might take advantage of it during this period. But in general, I'll maintain more heavy exposure to Bitcoin and ETH. I think Bitcoin's my biggest holding right now. And that's just the way I trade. That's also because I'm in capital preservation mode as well. So it depends what mode you're in. I'm still in this, I'm in a preservation bucket, right? Where I've got capital, which I'm trying to protect. And that's why I have money in Bitcoin, because I'm trying to protect wealth. For some of you, your goals may be just to make money at any cost. And if that's the goal, then, maybe you don't want to be as heavy weighted towards Bitcoin. Maybe you just want stables and then go, DCA into alts. It depends what your strategy is. But for me, as someone that's trying to protect a bit of capital as well as make money, I want to maintain decent exposure to Bitcoin. And when dominance looks like this, there's no reason to go out of that Bitcoin. We start reversing, maybe I'll shift some out. A lot of it's just in long-term storage, though. I actually did a tweet on this, which might be helpful for some of you. But once again, this is a reflection of where I am in terms of, my investing journey. I said I love investing in Bitcoin, but I don't treat it as a vehicle to make US dollars. I treat it as a vehicle to stack Bitcoin, similarly to how I view gold. A long-term bet on the debasement of fiat for myself and future generations. I'll use a percentage of my Bitcoin to trade in and out on the alt BTC pairs, but the majority is in long-term cold storage. So that's exactly how I view Bitcoin. It's a long-term bet for me. It is a bet on currency debasement. It's a bet on money printing. It's a bet on long-term the Fed not being able to stop what is basically the decline of a US dollar. And it's also a bet on CBDCs. I actually think Bitcoin is bullish if CBDCs get implemented, which they look like they will be, because inadvertently and accidentally, if you actually think about it, CBDCs are the greatest advertisement of crypto. They're advertising crypto tech, but with centralization. And people realize that it's good tech, but you can also have it with decentralization. I think that's actually an advert for crypto. So I view Bitcoin in the face of most economic events, long-term coming out ahead. Will it get smashed during times of uncertainty? Yes, because it's not truly digital gold yet. Is it still correlated to the NASDAQ? Yes. Will it decorrelate one day? I think so. I think it has the properties as hard money to decouple one day. And whether the altcoins run and follow it is another question. I think what'll end up happening, in my opinion, long term is Bitcoin will decorrelate. You will see liquidity inflows into crypto resulting in alt pumps, but in general, the altcoin market will be more a proxy for the NASDAQ and will continue to trade more like a tech stock even when Bitcoin decouples. That's kind of my gut feel, because if you think about what alts are, they're very different to Bitcoin. They're actually a bet on tech. They're a bet on a new, novel, innovative technology, and a bet on its potential use cases and network effect. A bet on Bitcoin is very different. It's actually, in my opinion, a long-term bet on currency debasement as a form of digital gold. And it's not really a tech investment. It is, because that's how it's being treated right now. But long-term, I don't view it as maintaining that narrative. I may be wrong, but then Bitcoin probably fails, right? Because that is Bitcoin's strongest narrative. That it's the most decentralized crypto, that it is a digital gold, or it can become a digital gold. If it can't succeed in that, then there's better tech. It's way better tech. You'd much rather just invest in Ethereum. So I don't really view Bitcoin as a way to make more dollars. If you want to make more dollars, alts. And if you want to protect your alts, trade back into Bitcoin, use the BTC pairs. That's essentially how I view the Bitcoin market. Okay, let's go a bit more zoomed in. Let's look at tomorrow and let's look at open interest. So open interest is essentially the indicator of how much leverage, open positions there are in the market, etc. Bitcoin right now, so we often see what happens is open interest has been tracking the Bitcoin price quite strongly. Bitcoin can't be stopped unless you literally shut down the internet. Yes, or unless quantum computers get created. But even quantum hacking, we have such an advantage. If you guys don't know what the quantum hacking theory is, I won't go too into it now, but it's essentially the theory that once quantum computers get powerful enough, with the assistance of AI especially, they'll be able to hack any seed phrase, because seed phrases are only 24 words. You can essentially bust into a seed phrase by like randomly spamming words. And one day computers will be powerful enough to do that. And yeah, that's the case, right? But crypto has a head start, because crypto has years and years and years until that happens to readjust its seed phrases. It can make them more complicated. You can move to a 48-word seed phrase or a 96-word seed phrase. You can go even crazier with it. And that doubles the amount of time it takes computers to work it out. It might add an extra 200 years on to the computational power needed to break in. So I don't view it as an issue. But yeah, it's really not even a headwind. It's kind of one of those headwinds that is very similar to like, that old anecdote about like gold mining on other planets. Like, there's often stories about like the government and space exploration institutions and stuff like planning to mine gold on other planets. And that's a headwind to the gold industry, right? Because if you can mine gold on another planet, then the supply of gold gets diluted and gold value goes down a lot, and that fucks the entire world economy. But it's kind of the same as Bitcoin, where like these events are so far in the future and so preventable. Like, there's enough time for the governments to establish gold economic measures to maintain price stability. There's enough time for Bitcoin and crypto groups to come up with new ways to protect the Bitcoin network, and there's upgrades that can occur. Like, there's all sorts of stuff we can do in the meantime. Really off on a tangent, but it is really interesting, the quantum hacking theory. So open interest, typically what we see is when it increases, when the Bitcoin price dumps, open interest dumps, of course. That's kind of what we've seen in recent times. Open interest did reach like a low when Bitcoin dropped. So on the 1 hour chart, let's go on to the daily chart. What could end up happening is, so open interest probably, I'm just looking at the chart here. Look, it's very stagnant. So actually on a weekly chart, open interest is very stagnant. What we have seen is severe dumps in open interest alongside Bitcoin dumps. The market isn't too frothy right now in terms of leverage. It is creeping up, but it's not too frothy. It has ticked up in the last few days though. And over the last day, open interest is actually up 3%. Let's see what happens at FOMC. I'm not going to trade based on OI now, pre-FOMC, but if leverage starts to significantly increase or decrease in the market one way, we'll have to make a risk assessment at that time. But just keep your eye on 𝗕𝗄𝗧𝗏. It's a great website. And just track how greedy the market's getting in terms of perps. Up 2.9% today in terms of open interest. So market's starting to speculate a little bit, clearly to the long side, because Bitcoin actually pumped today slightly. I mean, it's not like a massive pump, but it was a pump. Weird because my title's bearish, but the market did pump. But the last 2 hours have actually seen like a slight reversal. So tomorrow, just to summarize real quick, I've already talked about my thesis here a little bit, but we have FOMC. This essentially the only thing stopping the Fed from cutting rates significantly is a relatively strong unemployment market. So unemployment rates have still been pretty low. Until jobs data is really bad, like 4 or 5% unemployment, it gets really bad and it puts pressure on them to cut. This is, I guess, hawkish. You kind of want, and this is a terrible thing to say, because you actually don't want unemployment. Like, no economy wants unemployment. It's bad for the people and it's also bad for the economy. But we're in this fucked up situation where bad news is good news. The Fed would love to get inflation down, and if economic data is strong, like earnings have been, and employment data has been, they kind of want that, because that allows them to just keep hiking rates. But we know Bitcoin, we know risk assets, they don't thrive in high interest rate environments. Real estate doesn't thrive in high interest rate environments. You can't borrow as much to buy property. You can't borrow as much to build a business. You can't invest as much in your business. Economic growth decreases, etc. So you actually want a low interest rate environment. So if you are like in risk assets, you actually kind of want bad jobs data later this week to give the Fed a little less room to be so aggressive. because if jobs data keeps being good, then maybe they like push out their rate cuts slightly. That's why tomorrow, I think we almost disregard this because I think it's almost guaranteed we get a 25 bips rate hike, and we actually consider the dot plot, which is very important because that will give us the scope of how aggressively the Fed will hike or cut rates. As you can see by this chart, we are expecting the Fed now to raise 25 bips in this meeting tomorrow. Then for 2 months after that, pause and then start 2 rate cuts, November, December, October, November, later in the year. So those rate cuts will likely come after what is seeming to be a looming recession, and they'll then cut the rates, and then that'll be the official pivot. That's what the data is showing. This may alter, though, based on the dot plot. So that's probably more important than what Powell has to say. I don't think the market really gives much of a shit about Powell anymore because I think he will be hawkish. He had strong economic data. He had strong, decent jobs data in recent times. He's had decent enough economic data. GDP data was positive, only 1.1%, but albeit positive. He had strong enough data not to be too bearish. Too dovish. He had strong enough data to maintain his hard stance. And I think the market knows this. That's why there's been a de-risk ahead of FOMC. The market knows that he'll probably come out hawkish, but it's really the extent that the dot plot gets shifted in that direction. So do they delay the expectation of rate cuts by a month? Does another 25 basis point hike sneak in? Does Powell go super hawkish to the point where it just blasts markets away? I'm not sure. I don't know if they really trust what he has to say all that much. Could end up being a nothing burger, but those are just some things to look out for. It's why it makes it pretty hard to trade today. I will show you some trade setups at the end. I am trading the ByBit comp, but it makes it more difficult to trade today because you have a volatile event, which often affects the market. So let's look at how it affects the market, right? You can see on this chart, 7 of the last 9 FOMCs have resulted in dumps. What's actually happened, basically, before every FOMC is pump, dump, dump, pump, dump, sideways, pump, dump, pump, dump, pump, dump, pump, dump. So if you want to assume it ends up doing that again, then you would expect a slight pump today on Bitcoin and then a dump on FOMC. So you would expect maybe a pump into this region and then a dump. And that would be my amazing confirmation bias for the higher low. Because that would be, your local high, your next high, then your lower high, and then, lower high, not higher low, and then down. That would be your bearish indicator. But look at what happened after the FOMCs. So you have the dump, but then it pumps. Dump, and then it pumps. Dump, and then it pumps. Dump, and then it pumps. So look, tomorrow could be a dump, and then it could lead to the next leg up. But this isn't a big sample size, all right? This is only 7 instances. There's actually been no price pumps on FOMCs. There has been initial pumps, but it's always ended up being more bearish. But that's also, you got to realize that's also because we've gotten rate hikes for the last year. So of course the market's going to react negatively. So I don't think it's enough of a sample size to say, all right, it's guaranteed to be a dump. I think it's a little bit confirmation bias for us to do that. But something to note is that there could be a dump. Based on 7 of the last 9 times. How much weight you want to put to a small sample size is up to you. So if you are trading, look, I wouldn't go crazy in terms of positions. If you see decent setups, so for me, if Bitcoin pushes up into this range to make the lower high, anywhere in this zone could be a decent short zone. Now, how picky you want to be depends on how much leverage you use. I don't like to use crazy high leverage. That could be your short zone for the lower high, or this zone as well. Like a rejection back off the diagonal downtrend that we're currently seeing could be a short-term scalp zone. This is a bigger trade. This is a smaller trade. Those could be your short zones if you think there's going to be an FOMC dump. The problem is, what I want to keep you aware of is that oftentimes we do see wicks ahead, pre-FOMC, wick up, and then down. So if you get that, then you'll just get stopped out. So that's why it's not an environment where you want to be going into FOMC with a lot of leverage. If I do open a trade, it'll be small. I'm not going with huge leverage. Once FOMC happens, which is in, I think, 13 hours from now, 12 to 13 hours from now, I will be a lot are more open to opening bigger positions, and we'll get market direction then, and we'll get confirmation on whether this is actually a bearish trend playing out or whether we get a reversal. We'll get confirmation tomorrow, so we can be patient there. In the meantime, what I would do if you're a trader is start looking at setups. So get some altcoin charts up, start looking at your bearish and your bullish setups for all those alts. So if you're going to long an alt, get the strongest alts. How do you get the strongest alts? You go into the BTC pairs, you look at what are in the uptrends. Off the top of my head, Render, INJ, Joe, AVAX is strong on its USD pair, but not its Bitcoin pair. Mostly look at the Bitcoin pairs. Find 3 or 4 alts which are strong. PEPE is actually one of them as well. Find those strong ones, right? And if we get a good FOMC, those are the ones you long. If we get a bad FOMC, have 3 or 4 altcoins which look shit and short them. So what altcoins are breaking down on the Bitcoin charts, on your alt BTC chart? Look at those. I'll just go through a few now. I'll look and see if there's any setups on the Bitcoin charts. There's a lot of scribble from previous shows, mind you. Mia looks terrible. Matic looks terrible. I mean, Doge looks okay. Actually, higher. What we're looking for is like lows. Gala looks bad. Phantom looks bad now, I'm sorry to say. Its USD actually looks okay. On a macro level, it looks okay, but in short term, it looks not great. Most alts look bad, right? IMX looks bad. They're all bleeding versus BTC. This is also why I'm not aping into alts. That's why the title of this video is actually not bullshit, because alts have been bleeding versus BTC, and a lot of them are far from their support levels. So it's not like you're getting like support buys. A lot of like breaking now down below their final levels on the BTC pairs. Yeah, 25 bips is like basically a guarantee at this point. If it's not, I'll be shocked. If it's 0, expect a freaking moon time from Bitcoin. Expect a moon time from Bitcoin. But how can it be 0 with good economic data Q1? Like, it can't be. It won't be 50 bips either. It'll be 25. Should be 25. The market does say there's a tiny 13% chance there's no hike. But I would be shocked. I would be shocked if there's no hike. It's going to be 25. I'll be freaking shocked. By the way, Ted did a good tweet if you want to read this. I won't read it out now, but he did a good tweet on the FOMC. So just to summarize the altcoin point, get a few hot ones that you're ready to long on their Bitcoin pairs. Get a few bad ones which look ready to short. And then when FOMC happens and we get confirmation on our Bitcoin chart of Bitcoin's next move, if it is in fact down, then you will have the weakest alts to short, because you don't want to short Bitcoin, you want to short alts. Why do you want to short alts? Because dominance is high and alts look bad. ETH BTC is the leader of alts. It's a downtrend, right? So you want to short alts. And then if it is bullish, then you have a few strong alts as well. That's from the trading perspective. Now, if you are trading, you might want to do it in the comp. I don't know if you guys are already in the comp, but if you're not, there is a link in the description. This will give you entry to the ByBit Trading Comp, where we're giving away a Tesla. Click that link, sign up, and register. I'm ranked 490 because I haven't actually opened a trade yet, but there are some people already doing quite well. Number 1 prize is the Tesla. Number 2 prize is a Rolex. And number 3 prize is $10,000. So huge prizes in the comp if you want to get involved and open any of these trades post FOMC, or gamble pre FOMC if you want. There are decent setups now, but it's just a lot riskier to go in with huge positions pre FOMC. So there's a link in the description to that. I will take a few questions now, so just drop questions in the comments below, and I'll go through and I'll answer, and I'll hang out with you guys for 10 minutes. Get out of banks now. Well, I actually have a theory about what's happening with the banking collapse, and it's not good. But what I basically think is happening is, just as like a small TLDR, the banking sector has, from 1920, gone from 30,000 regional US banks to 4,900 this year. We're seeing smaller banks being gobbled up by bigger banks like JP Morgan and Bank of America and Wells Fargo, and these big players. They're gobbling up the banks. And you can actually see the banking sector. I'll get up a tweet now which shows this quite nicely. You can see the banking sector is condensing into a few big banks. I'll show you now. 𝗕𝗐𝗵𝗧𝗵𝗐𝗵𝗐. Let's go to JP. I don't know where this tweet is, but I'll look up bank market share, US. Basically, what you need to know is that the banking sector is condensing. Can I get the bank market? 𝗕𝗊𝗁 did a tweet on this. It was on Rand Show yesterday. I don't know where it is. But anyway, it doesn't really matter because I know the data basically off the top of my head. So off the top of my head, without getting the exact data up, JP Morgan makes up, I think, 15% of the US banking sector. Bank of America makes up 10%. Wells Fargo makes up 5% off the top of my head. So you can see that over 40%, if you add it all up, of America's banks are controlled by just 10 banks. Over 70% of deposits are controlled by the top 15 banks. Data might not be right because I need the tweet, but all you need to know as a TLDR is we've gone from 40,000 banks to 4,000 and shrinking. What does this mean? It means more power is in the hands of fewer in America. There's also a speculative theory, which, to be honest, I subscribe to, which is that a condensed banking sector makes it much more efficient and easier for the government to roll out CBDCs. They don't want objections from smaller banks. They don't want to deal with the hassle. They want to be able to roll out a CBDC, have the support of every single major bank, and do it quickly and efficiently. And what is the easiest way to do that? Well, it's to have the top 4 banks controlling the majority of deposits in the country. JP Morgan is also incentivized to let small banks collapse because it can gobble them up, gain more market share, and get a discount because the FDIC has stepped in, which is, by the way, funded by taxpayers, to underpin deposits, which is crazy. So basically, you've got the FDIC helping JP Morgan sweep up smaller banks, and the bigger players get bigger and bigger and bigger. And the American banking sector gets bigger and bigger and bigger. It's a big issue, and it's becoming a bit of a conspiracy, but not in like a crazy speculative way, but in like, actually, fuck, this is like signaling what could potentially be the preparation for a CBDC. And if that isn't the motive, and if it is a genuine organic banking collapse, it's still an oh fuck moment, because it suggests that the power and wealth concentration in the US is now in the hands of even fewer. 40,000 to 4,000 banks is already crazy. That could be as little as 1,000 banks in the next few years. And then eventually, like 3 or 4 banks will just own the entire American economy. It's really ugly. It's really scary. I don't like it. But unfortunately, that's the scary reality of the banking collapse. So, I mean, we also know the Fed is happy to step in. So more banks collapse, more liquidity injected, could end up being a Bitcoin bull catalyst. It could. It's just very difficult at the moment because you have conflicting macroeconomic data, and then what could be a bullish bank collapse. Terrible for the economy, bullish for risk assets because of money printing. At the end of the day, all roads lead to Bitcoin. It just depends when the road's going to come. Does it come later in the year after a recession? Does it come now? Like, when does the road, does it come in 2 years? Like, when does the road really pave the way for Bitcoin? Because all roads are leading to Bitcoin, in my opinion. But that's, obviously long term. Short term, you can see correlation in the midst of a stock market decline. Stocks are also relatively close to resistance. Let the US default declare bankruptcy. I mean, bro, look at every economy over time has had to collapse to rebuild. Like, America had its time in the sun, but this is like the signs of a dying economy. De-dollarization is a huge risk as well for America, having other countries now settling in other denominated currencies for trade settlements. So the US has a lot of headaches. You can basically take on as much debt as you like when you have the world's reserve currency. When you don't have the world's reserve currency, well, that really puts a limit on how much debt you can take out. And that could really start to hurt the US in terms of its ability to borrow. And if it can't borrow, and if other nations don't want to invest in the US and don't want to buy US Treasury bills, then it becomes a major issue. It becomes a huge issue for the US, and that would be the downfall of the US. And I don't know. It seems like it's on the brink now, but on the brink could be 30 years. Like, this is the thing people have to realize. Crypto moves quick. Stocks move quick. The collapse of a nation moves slow. I mean, that takes decades to play out. So I think people overestimate what can be done in a short term and underestimate what can be done in the long term. And I think you can apply that logic to America and other nations. Their downfalls take just as long as their rises. So that could be decades. So it's not like you got to panic out of USD today. Frick, you'll get, if you want, you'll get years to do it. But there's no reason to panic. And if you're in America, there's no reason to, I don't know, it's your life, but there's no reason to like move and panic right now. It's like, that would be knee-jerk. This shit takes ages to play out. Okay, let's get back into crypto quickly. And I'll do some rapid fire questions. What's my view on PEPE through the Fed announcement? PEPE doesn't give a shit about the market, but a bullish Fed, which I don't think it'll be bullish, but if Powell is really dovish for some reason, he may be dovish. If he is, then I think PEPE actually outperforms just because of relative strength. Yeah, I actually view it good for the market because it's good for consumer sentiment and PEPE is a sentiment play. But it isn't that correlated, and even a bad Fed meeting probably doesn't ruin PEPE either. Let's see. It is a big risk, obviously. Can you win the competition by ByBit account is not open from the Banter referral link? Unfortunately not, but you can. Fortunately not, actually. I think you can probably create a new account with the Banter referral link, though, with a new email. That would be your best option. By the way, if you don't want to trade on ByBit, I've been using PrimeXBT recently. I think it's really good. ByBit obviously soon implementing KYC, so that might if that affects you, then and you want to look for other exchanges, obviously Bit gets one of them, but I think PrimeXBT is like a really good exchange to trade on. I'm not just saying this, like I recently started using it. They're also a partner of the show as well, and they have Forex. So if you do like to trade Forex and commodities and other sorts of assets, they've got a lot of Forex pairs as well. So they are running a welcome bonus at the moment, which is a $7,000 sign-up bonus for PrimeXBT. If you use the link in the description, and you want to use PrimeXBT, once again with KYC coming in to ByBit in a few days, let's say you don't want a KYC, then you can use the promo code Miles. It's automatic on the link, and get that $7,000 bonus. And also, if you deposit $500, you get $100, $100 bonus. Read the T's and C's, but yeah, they're doing $100 bonus as well. So decent bonus for you guys, but we're also working on a custom giveaway or trading comp or something with them. So yeah, if you want to trade there's a link in the description. It has been a very nice platform to use, and it's just another option in an ever shrinking exchange environment. I'm still going to use ByBit. I'm KYC'd, but I know for some people they don't like it. Look, it just depends. I don't know. I don't have anything to hide. I don't really care. I'm happy to KYC. I don't really trade with monstrous amounts on ByBit, but if you have a problem with it, I guess there's other options. Do you need to KYC? Read the T's and C's. Read the T's and C's. Let me actually look for you. Okay. Yeah, you will actually, because it says here, always read T's and C's when you join comps, just to understand how it works. For 50 cash award, as long as no, that's just 50. Hold on. I don't want to scare you. It doesn't say anywhere that you need to KYC. New users to join the competition complete KYC level 1, you'll receive $50. Cool. That's got nothing to do with if you can win the prize or not. I know. So you need to KYC in 5 days. So if you're in the lead in 5 days, I think you could probably just stop and not. But can I ask you why you care though? Because like for us to give you your prize, we'll need to know who you are anyway. If you win the Tesla, we obviously need to know who to address it to. If you win the Rolex, we need to know who to address it to. And subsequently, ByBit is going to find out because we're going to need to tell them who to give the Tesla to. So like in a roundabout way, yeah, you're kind of going to need to KYC to win the prize, if that makes sense. It doesn't actually say it. Read the T's and C's. I just did a quick scan, but it doesn't explicitly say it. But I'm pretty sure we'll need to know who you are to give you the Tesla. I don't see it mentioned there either, Jay. I see it mentioned for the $50 though, if you want to make $50, but I don't see it mentioned. Cool. Well, I think that's it for today. I appreciate you guys hanging out with me. Hopefully that gives you a rundown pre-FOMC. Good luck if you are trading FOMC. Of course, we've got links to PrimeXBT, as well as the ByBit comp and the OKX comp in the description if you are trading. Lots of giveaways at the moment. Hopefully we get some decent setups over the next day, especially post FOMC. And I'll come on tomorrow and give you guys an update as to what I'm doing in exactly 24 hours, basically. And that will be a few hours after FOMC. The market would have settled and we'll have direction. I'll see you in the next one. Peace out. Have a lovely day.